that is changing everything could still leave you broke, just like the internet did to millions of investors in 2000. This isn't fear-mongering. It's a warning from billionaire investor Howard Marks, who saw the dot-com crash coming. His take? The AI boom is rhyming with 1999. And it's not just the flashy AI stocks at risk. Even the, quote, boring investments you trust might be overpriced. Marks uses a one-line test to cut through the hype. Listen for it.
In the fall of 99, there was a big bubble, one of the greatest bubbles we've ever seen in the stock market. It was called the TMT bubble, Tech Media Telecom bubble, but nowadays we call it the Internet bubble. Everybody assumed that the Internet would change the world. They extrapolated that to mean that an Internet stock or a stock with the name Internet in its name was worth infinity. And, that fall of 99, I was reading a book by Edward Chancellor, a financial historian, called Devil Take the Hindmost, a history of financial speculation. And I was reading about, in particular, the South Sea bubble, in which England figured it would get rid of its national debt by creating a company, the South Sea Company, and giving it a monopoly to trade with the South Sea. And people went crazy over that stock, and they took off from their jobs to day trade in that stock and so forth. And as I read about people's behavior, I said, holy cow, that's exactly what's going on now in the tech stocks. And so, that was the starting point, and I wrote a memo about the misbehavior that I saw taking place in the market for tech stocks.
The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. I wonder whether there's a big relevance of that today as well as there was back in 99, 2000, because with this race of investment in the space of AI, there are quite a few players competing out. Not hundreds, but it's also not like the last decade where basically Google had a monopoly on search, for example. Is that quote relevant today as it was in 99?
Oh, it's always relevant. One of the most important sayings was from Mark Twain, American author, who said, history does not repeat, but it does rhyme. There are certain themes that rhyme from cycle to cycle or generation to generation. And what are the characteristics of bubbles? Number one, it invariably surrounds something new that triggers the excitement, gets people going. And since there's no history of it, there's no indication of what its limitations might be. And then people get excited about the new thing, and they assume that it will change the world, and then they assume that that will result in profitability, which is not always a strong assumption, and that was one of the comments I made in the memo about e-commerce. Then they assume that the incumbents will succeed, whereas they may be replaced. And in the extreme, they assume they'll all succeed, which may be unlikely. But, the opportunity to buy the stock in each one looks like a lottery ticket that could pay off in millions. So these are some of the threads. And Buffett said 25 years ago about the Internet that the Internet will certainly increase efficiency, but will it increase profitability? Which is to say, for example, what if all the companies in a given industry get AI, they compete to use it, they all put it to work, it increases efficiency for all of them, but they compete for business by cutting their prices, and that eliminates the unusual profitability of that industry.
Marx is saying history is rhyming. In every bubble, a game-changing innovation gets investors euphoric. But here's what nobody wants to hear. Changing the world isn't the same as making money. Think back to the late 1990s. People quit their jobs to day trade dot-com stocks. The Nasdaq surged fivefold, from about 1,000 to over 5,000 between 1995 and 2000. Pets.com became a Super Bowl advertiser with a sock puppet mascot, despite burning through $147 million and never turning a profit. Then reality struck. When that bubble burst, nearly $1 trillion in stock value evaporated within weeks. The Nasdaq plunged almost 80% by late 2002. If you had $1,000 in a Nasdaq index fund at the peak, you watched it shrink to roughly $200 at the bottom. Being right about the technology didn't save your investment. Now look at today's AI boom. We're seeing a similar feeding frenzy. In April 2024, a fashion rental company, Rent the Runway, announced it would use AI, and its stock surged 220% in one day. Did its profits suddenly skyrocket? No. That kind of jump on an AI headline is a classic bubble signal. So the lesson for Marks is clear. A great technology isn't automatically a great investment. You have to ask, who will have the moat and pricing power when the dust settles?
The other 493 companies in the S&P 500 are selling at a PE ratio, I don't know if it's 19 today or 20 or 21, something like that. Why should the other 493, which are much more mortal, be selling at PE ratios above the historic average for the S&P over the last 80 years? So this is why I say that I think that the S&P is valued highly. And I think in a memo last year I said lofty but not nutty. But if you are a conservative person, and if you don't mind that much missing out on some gains, but would really mind participating fully in a decline, then this is a time when you might want to take some chips off the table.
Marks just flipped the script. The 7 superstar tech giants have high PEs for 193 companies in the S&P 500. Those everyday companies, the banks, retailers, and industrials, are trading at around 19 to 20 times earnings. That's well above their historic average PE of about 16 times. Even the quote mortal companies without AI level growth are priced like premium growth stocks. Here's the catch. High PEs usually mean lower future returns. Marks referenced research showing that if you buy the market at around a 23 times PE, the average annual return over the next decade has been something like plus 2% to minus 2%, basically near zero. Right now,